Hello everyone, a very good evening. Welcome to the marathon session for our Module A. So, in the morning, in the capsule lecture, we have completed our Module A, and today we'll be practicing the most important questions. MCQs are here, multiple selection questions, case studies, everything. Okay? So, just try to be active, try to answer the questions, and download the PDF once the session is over because here in the PDF, along with the questions, the correct answers, I've also provided the explanation so that you can revise later on. Just keep on noting down the topics if you get any question wrong, and then make sure that you go through the PDF of the capsule lecture that we have provided. All right, so let us start with the first question for today. Okay, under the section 5B, the most basic question under the Section 5B of the Banking Regulation Act 1949, which of the following is not an essential function of banking? Acceptance of deposits of money from the public, lending or investment of such deposits, acceptance of deposits of gold and jewelry for safekeeping, repayment of deposits on demand or otherwise. So we have studied the definition of banking under the Section 5B of our Banking Regulation Act, right? We studied that there are two functions: accepting deposits, which are repayable on demand, and using those deposits to create loans and advances and to make investment, right? However, acceptance of deposit of gold and jewelry, it is not an essential function. Banks, they do keep it for safekeeping, they provide the locker facility, but it is not an essential function. Essential function is only two: accepting deposits and giving out loans and making investments in the securities. So the correct answer will be C. All right, the correct answer will be C. Everyone who is here, please try to answer the questions. Drop down the correct option, whichever option you think is correct. Okay, next. Which of the following statements correctly reflect the licensing and naming requirements under the Banking Regulation Act? License from RBI under Section 22 is mandatory to commence the banking function. Every banking company must use the word bank as part of their name. Any individual or firm can freely use the word bank in their business if they deal with money. Certain cooperative societies and will grant the license on the terms and conditions of the paid up capital, of the permitted activities, not permitted activities, all the conditions. And once they get the license, they have to use the word bank, banking, or banker, and no other firm than the banking company is allowed to use the word bank in their business name. Doesn't matter whether they are dealing with money or not. Okay, so the correct answer should be 1, 2, and 4. And yes, there are certain exceptions as well. Like this exemption or is given to a subsidiary of a banking company. It is not necessary for them to use the word bank. Subsidiaries of banks, associations of banks, primary credit society, a cooperative society for the purpose of protection of the mutual interest of the cooperative bank, right? Formed by the employees of a banking company, SBI or nationalized banks, they are also exempted from this restriction, right? So the correct answer will be B, 1, 2, and 4. Which of the following activities are permitted under the section 6.1? So section 6 talks about the permitted business. Section 8 talks about the prohibited activities, those activities that the banks are not allowed. So what comes under the permitted business? Buying and selling of bills and exchange, carrying on guarantee and indemnity business, managing property acquired in satisfaction of claims, direct trading in commodities like sugar or cotton. So which of these activities are permitted? Which of these activities are allowed? Answer this question. What are the correct statements? 1, 2, and 3, 2, 3, and 4, 2 and 3, or 1 and 4. Right. So when we talk about the permitted business, the main business of banks is acceptance of deposit, lending and investment. Other allied unrelated activities like dealing in bills of exchange, drawing, accepting, buying, selling of the bills of exchange, advancing of money with or without security, carrying out the transaction of guarantee, indemnity, realizing a property that came into its possession as a security for the loan, it is allowed. However, prohibited business, a banking company is prohibited from engaging directly or indirectly in trading activities and undertaking the trading risk. Buying, selling, bartering of goods is prohibited. When we talk about goods, it means movable property other than actionable claims. Okay, so the correct answer should be 1, 2, and 3. Option A. Right? Option A is correct. 1, 2, and 3. Fourth statement is incorrect. Direct, indirect trading of immovable property is prohibited, not allowed. Sorry, movable goods. Which of the following appellate powers are vested in the central government under the Banking Regulation Act? So, RBI is the main regulator, the supervisor of the banks. Certain powers to be used in exceptional situations are also given to the central government. Right? We have studied about the section 7, if you remember, the section 7 subsection 1 of the RBI Act, where the government has been conferred powers to give directions to RBI wherever considered necessary. In 2018, separate letters were given regarding liquidity for NBFCs, capital requirement for weak banks, lending to the SMEs. Similarly, certain wherever RBI, let's say, takes a decision to remove a director from the board of the banking company, or any officer or any employee, they have the right to make an appeal. So here the appellate authority is the central government. So what are the appellate powers? Appeal against RBI's monetary policy decisions, appeal against removal of managerial personnel, appeal against cancellation of the banking license, appeal against refusal of certificate regarding floating charge on the assets. What should be the correct answer? 1, 2, and 3, 2, 3, and 4, 2 and 3, or 1 and 4? Which option is correct? The appellate powers that the central government has. If RBI removes the managerial personnel of the bank, yes, within 30 days of the decision, they can make an appeal to the government. Cancellation of banking license, refusal of certificate, the banks can also make an appeal to the central government within 30 days. Right? Exemption from any provision of the Banking Regulation Act, any business that they want to engage that requires government's permission. However, appeal against RBI's monetary policy cannot be made. RBI has the whole sole authority to decide the monetary policy. Okay, so the correct answer will be B. 2, 3, and 4. Statement 1 is incorrect. No appeal can be made against the monetary policy decisions of our central bank. Okay, yes, so the correct answer is 2, 3, and 4. Under the section 19 of the Banking Regulation Act, a banking company requires government approval for. Under the section 19, what is required? Which approval from government is required? Appointment of managerial personnel, issuance of preference shares, acceptance of deposits from the public, formation of a subsidiary for a certain business. Yes, usually all the approvals are taken from RBI. But if the bank wants to form a subsidiary, if the bank wants to form a subsidiary, then they are required to get an approval from the central government. Okay, this is under the section 19 of the Banking Regulation Act, where if they want to form a subsidiary for a business other than that which is permitted by RBI, they need to get a approval from the central government. All right. Okay, so the correct answer is D. Which of the following are true about RBI's discretion on licensing under the Section 22? So, when the bank, any financial institution, they apply to get a license, RBI has full discretion to grant them the license or reject their application. So, what powers does RBI have in this regard? RBI may impose conditions while granting the license. RBI may stipulate higher capital requirements than the Section 11 minimum. RBI must be satisfied about the adequate capital structure. RBI's decision is automatically subject to appeal before the central government. Which statements are correct? When RBI is granting license, what is the license requirement? Here, to commence or carry on the banking business in India, the company requires a license from RBI. When the Act came into force in 1949, the banking companies which were already in existence, they were also required to apply for the license within 6 months from the commencement of the Act. And only if the license was given, then they were allowed to continue, otherwise not. Now, RBI has the discretion. The RBI can refuse the license or RBI can approve the license upon whatever conditions are there. So RBI will check whether the company will be or in a position to pay its present or future depositors. The affairs of the company will not are not being conducted in a manner detrimental to the interest of the depositors. The general character of the management, the managerial personnel, the directors, they have a good moral background, all of these things, right? RBI can stipulate a higher minimum balance requirement, yes, and RBI has to be satisfied that adequate capital structure has been created by the bank. However, it should not be easy to question the RBI's decision before the central government. All right, it should not be easy to appeal against the decision of RBI to the central government. Only when the central government, if even if an appeal is made, the central government, if it thinks that the cancellation is correct, that RBI is refusing the license for good reasons, for appropriate reasons, the government supports that decision. No further appeal can be made against it. All right, so the correct answer will be A. The small finance banks in India are registered as private limited companies under the Companies Act 2013, registered as public limited companies under the Companies Act 2013, registered under the RBI Act of 1934 directly, registered under the Payment and Settlement Systems Act of 2007. So when we are talking about the licensing policy for the SFBs, the licensing policy for the small finance banks, what should be the correct answer? They are registered as a public limited company under the Companies Act of 2013. And after their incorporation, they will get license under the Section 22 of the Banking Regulation Act. They're also governed by the RBI Act, the FEMA Act, Payment and Settlement Systems Act, CIC, the prudential regulations they need to follow, and they will be given the scheduled bank status once they commence their operation, right? They will be given the scheduled bank status by RBI once they start their banking operations. Okay. Under the section 11, subsection 3, the minimum paid up capital and reserves for an Indian bank with places of business in more than one state, including Bombay or Calcutta is. So if an Indian bank has places of business in more than one state, and that place of business includes Bombay or Calcutta, Then what is the minimum paid up capital reserve requirement for such an Indian bank? When we talk about the paid up capital and reserves, like for the Indian banks, if it has a place of business in more than one state and they are required to maintain the paid up capital of 5 lakh rupees. However, if they have a place of business in Bombay or Calcutta, then they are required to maintain rupees 10 lakh, right? 10 lakh. If it has all its places of business in one state and none of which is situated in Bombay or Calcutta, then 1 lakh rupees. Okay, so remember these points. One state and not Bombay or Calcutta, so 1 lakh rupees in respect of the principal place of business plus 10,000 rupees for other places of business in the same state, in the same district in which the principal place of business is there. And outside the principal place of business, 25,000 rupees for each place of business. If it has a place of business in more than one state, again, not in Bombay or Calcutta, then they are required 5 lakh rupees. And if more than one state and the place of business is in Bombay or Calcutta, then they require 10 lakh rupees minimum paid up capital. All right. So these are the points. One more point is there. If it has all its place of business in one state and one of the place of business is also in Bombay or Calcutta, then they are required one state, Bombay, Calcutta, then they are required to maintain 5 lakh rupees plus 25,000 rupees in respect of each of the place of business outside Bombay or Calcutta. So in Bombay or Calcutta, they will have the principal place of business for that 5 lakh rupees. Outside Bombay or Calcutta, 25,000 rupees in respect of each place of business, right? However, the maximum aggregate value will be 10 lakh rupees in this case. And in the previous case, where the place of business is not in Bombay or Calcutta, the maximum aggregate value will be 5 lakh rupees. Okay, 5 lakh rupees for the previous one here and 10 lakh rupees for the Bombay and Calcutta requirement. Okay. Which of the following provisions apply to the Indian banks under the section 11? So I've explained each and everything to you. Now answer this question. Aggregate capital requirement capped at 5 lakh rupees for banks that have all the branches in one state, excluding Bombay or Calcutta. Banks with only one place of business cannot be required to have more than 50,000 capital and reserves. Banks commencing business after the 1962 amendment must have minimum 5 lakh capital. Banks with branches in Bombay or Calcutta must have 25 lakh rupees capital. So which of these statements are correct? 1, 2 and 3, 2, 3 and 4, 2 and 3, 1 and 4. Which of these statements are correct? So we discussed, right? If the bank has a place of business in only one state and none of the place of business is situated in Bombay or Calcutta, then for the principal place of business, 1 lakh rupees, outside the principal place of business within the same district, 10,000, and outside the district, 25,000. Maximum will be 5 lakh rupees. Total cannot be more than 5 lakh rupees. So correct. Banks with only one place of business cannot be required to have more than 50,000 capital and reserves. Yes, true. Then banks commencing business after the 1962 amendment must have 15 lakh rupees capital. Right. If the banking company has only one place of business, they will be required to have the paid up capital and reserves not exceeding an aggregate of 50,000 rupees, right? And in case of every banking company that came into existence after the 1962 amendment, the value of its paid up capital will not be less than 5 lakh of rupees. This is also correct. But when we are talking about those banks that have branches in Bombay or Calcutta, the minimum paid up capital is 25 lakh. No, incorrect. All right. If it has a place of business, it will depend whether in one state or more in one state, more than one state. So the correct answer should be A, 1, 2, and 3. All right, 1, 2, and 3. So 5 lakh rupees in respect of the place of business in Bombay, Calcutta, 25,000 rupees in respect of each place of business outside it. Maximum will be 10 lakh rupees. Okay, so minimum 25 lakh capital is incorrect. This topic is very important, so make sure you remember it. Make sure you remember it correctly. Do not get confused in the exam. Do not mark it wrong. All right. A foreign bank with branches in Delhi and Mumbai earns rupees 50 crore profit from Indian operators. What deposit obligations arise under the section 11? So what is the deposit obligation for the foreign bank? It has a place of business, it has branches in Delhi and Mumbai, and they're earning rupees 50 crore from the Indian operations. Deposit 15 lakh with RBI plus 20% of 50 crore profit. Deposit 10 lakh with RBI only. Deposit 25 lakh with RBI plus 10% of profit. Deposit 20 lakh with RBI plus 20% of the 50 crore profit. So what should be the correct answer? A foreign bank which is operating in India. First, they have to deposit and they have to keep deposited with the RBI an amount of 15 lakh rupees normally. Okay, an amount of 15 lakh rupees. However, if it has a place of business in Bombay or Kolkata, then they need to keep deposit rupees 20 lakh. So this deposit has to be made, right? And it has a place of business in Mumbai, so 20 lakh will be applicable. Then, apart from this, they also need to deposit an amount of 20% of their profit for each year in respect of the business transacted through the branches in India. So 20% of rupees 50 crore, which is the business from Indian operations. Right? So the correct answer will be D. Deposit 20 lakh rupees with RBI. Keep it deposit at all time. They cannot reduce it by any manner. And 20% of the profit for every year as they have disclosed in the profit and loss account. All right. The securities can be replaced by unencumbered approved securities, cash deposit. Similarly, they can be replaced or a combination of both. Okay, so this is the requirement for the foreign banks. 20 lakh deposit if it has a place of business in Bombay or Calcutta, 10 lakh if not in Bombay or Calcutta, and 20% of the profit from their branches situated in India. Okay. Which of the following statements does not correctly reflect the section 12(1) of the capital requirement? The section 12 talks about the paid up capital, subscribed capital, and authorized capital. The relation between the three I have explained to you. So the subscribed capital must be at least half of the authorized capital. The paid up capital must be at least half of the subscribed capital. RBI may waive these requirements permanently. Compliance with the capital increase requirements must be achieved within 2 years. So, what should be the correct answer? The relation between subscribed capital, paid up capital, subscribed capital, and authorized capital. Everyone who's here, please like and share the video and try to answer the questions. Do not just watch, try to answer the questions. So, what is the relationship? The relationship says that the subscribed capital of the banking company shall not be less than half of its authorized capital, and the paid up capital shall not be less than half of its subscribed capital. This is the relation, right? And if the capital is increased, the requirement has to be complied within a period not exceeding 2 years. But RBI cannot and will not waive off the requirements permanently. So the incorrect statement is C. That is, here the incorrect statement was asked. So for us, the correct answer is C. All right. So the authorized capital, subscribed capital, and paid up capital, 4 is to 2 is to 1. At any point, if the authorized capital increases to, let's say, 6, the subscribed capital will be brought to 3 and the paid up capital will be brought to 1.5. Within what time period? Within 2 years, it has to be adjusted. Okay. So the authorized capital, subscribed capital, and paid up capital of the banking company. This is the requirement. This is the relationship. Okay. Under the section 19, the ceiling on shareholding by a banking company in a non-subsidiary company is 10% of the paid up capital of that company, 20% of the capital of that company, 30% of the paid up capital of that company, or 50% of the paid up capital of that company. When we are talking about shareholding in banking companies, shareholding in by the banking company. So in the subsidiaries, obviously, they will have majority shareholding. However, in other companies, there's also a ceiling. For the subsidiary, there's a ceiling. There's also a ceiling for other companies. So the bank, when they're holding in any company, the shares as a pledgee, mortgagee, or absolute owner, it will not exceed 30% of the capital of that company, 30% of that capital or the paid up share capital and reserves of that company, or 30% of the banking company. All right. And also, if the managing director of a banking company is interested, there the bank is prohibited to have any shares. The banks are prohibited to invest. So the correct answer is C. Remember all of these points. 30%. Maximum shareholding is 30%. All right. What is the voting share restriction? There's no ceiling on a person holding shares in the banking company except for the 5% of the paid up capital. But voting right maximum is 10%, right? 10%. If anyone at any point gets more than this 5% or 10%, it should be with the prior approval of RBI. Also, reports on the shareholding should be done. Okay. Which of the following are mandatory requirements for the directors under the section 10A? At least two directors must have knowledge or experience in agriculture, rural economy, cooperation, or small scale industry. Directors must not have substantial interest in trading or industrial concerns, except the small scale industries. Directors must hold office for a maximum of 8 years continuously, except the chairperson or the whole time directors. Directors must be shareholders of the bank. Try to answer this question. Which of these statements are correct about the requirements for a director? Requirements for a director in the banking company. So, when we are talking about the appointment of directors in the banking company, there are certain qualifications, like at least 51% of the total number of directors should have special knowledge or practical experience with respect to accountancy, agriculture, rural economy, banking, and at least two should have special knowledge in agriculture and rural economy or cooperation or small scale industry. So, this is correct. The directors should not have a substantial interest. They should not be connected as an employee, manager, or a managing agent in a company or a firm that is carrying out trade, commerce, or industry, right? However, small scale industrial concerns are not included here. The period of office, the directors of the banking company shall not hold office for more than 8 years continuously, right? However, holding shares is not a mandatory requirement. So the correct answer will be A. It is not mandatory that the directors must be the shareholders. When we are talking about the directors, the chairpersons, even the additional directors, they are exempt from this requirement. They are exempt from this requirement. Okay, so that is the correct answer. The maximum continuous tenure for the directors of a banking company under the section 10A. Exactly this question was asked in your June exam. What is the tenure? And it was a very simple question. So is it 5 years, 8 years, 10 years, or unlimited subject to the RBI approval? Right now we have discussed it is 8 years. For the directors, it is 8 years continuous. They're also eligible for reappointment. Yes, they are. Okay, they're eligible for reappointment. However, if a chairperson or a whole time director is removed, they will now not be eligible for further appointment for a period of 4 years. All right. A chairperson of a bank is removed from the office. What restrictions apply under the section 10A? Just now I told you. So he may continue as a director but not as a chairperson. He may be appointed immediately with RBI approval. He can be reappointed after 2 years. He ceases to be a director and cannot be reappointed for 4 years. So what is the restriction? When a chairperson or a whole time director is removed, they are removed, they cease to be a director. The chairperson is elected from among the directors itself, but once they're removed, they no longer are the director of the banking company, right? And they are not eligible for further appointment for 4 years. Okay, they are not eligible for further appointment for minimum 4 years. Okay, yes. A whole time chairperson of a bank resigns suddenly due to illness. What is the maximum period for which temporary arrangements can be made to carry out his duties with RBI approval? So, what should be the correct answer? What should be the correct answer? To fill up the temporary vacancies, the correct answer will be 4 months. All right. In the absence of a chairperson, the management is given to a managing director. Temporary vacancies in case the whole time chairperson or the MD dies or they resign or they're incapable of discharging their functions due to illness. Temporary arrangement, temporarily another person can be appointed in their place for a period not exceeding 4 months, and it has to be done with the approval of RBI. Approval of RBI is required. So remember, 4 months. These temporary arrangements are made for 4 months. All right. Which of the following statements correctly reflect the tenure provisions for the whole time chairperson or the managing director? The directors we have discussed, 8 years. What about the whole time chairperson or the MD? Tenure cannot exceed 5 years at a time. They are eligible for re election or reappointment. They cannot hold office for more than 8 years continuously. They may continue in office after the expiry of term until the successor assumes office, subject to the RBI approval. So, what should be the correct answer? When a whole time chairperson or the MD is appointed regarding their tenure. So the correct answer is that they will hold office for 5 years. Okay, 5 years. 8 years is for the director. So the correct answer will be D. 1, 2, and 4. 1, 2, and 4. Tenure cannot exceed 5 years. They're eligible for reappointment and they may continue in office after the expiry of the term until the successor assumes. Even if a temporary person is appointed on their place, what will happen? For that remaining period only, they are going to hold the office. The remaining period until the successor is appointed, a new person on the permanent basis is appointed, on the whole time basis is appointed. Okay, so 1, 2, and 4 is correct. Under the section 10C, the whole time chairperson or the MD of a banking company is required to hold qualification shares, exempted from holding qualification shares, required to hold at least 5% shares in the bank, required to hold shares only if appointed by the RBI. So when a whole time chairperson or the MD is appointed, what is the shareholding requirement? The whole time chairperson or the MD is exempted from the requirement of holding qualification shares. Even the directors that are appointed by RBI, they are also exempted, right? They need not hold any qualification share as per their position, right? So this is an exemption given to them. The correct answer will be B. They are exempted from holding the qualification shares. See, you need to go through this explanation. All of the important points are included here. So once download the PDF when the session is over, whenever you get time, 5 minutes, 10 minutes, go through all of these provisions. All right. Which of the following apply to the additional directors appointed under this section? Hold office during the pleasure of RBI, maximum of 3 years at a time, not required to hold qualification shares, not liable for acts done in good faith, counted for reckoning the proportion of total number of directors. Yesterday, I emphasized on this additional directors. When the additional directors are appointed, if the RBI is of the opinion that it is in the interest of the banking policy or public interest or the banking company, from time to time, with effect from such date, RBI can order to appoint one or more persons as additional directors of the banking company. They are ordered by RBI, so they will hold office during the pleasure of RBI. They can be removed by RBI only, but maximum 3 years at a time. Okay, maximum 3 years at a time. More than that, RBI may specify. They will not incur any obligation or liability just because he's a director for anything that he did in good faith. So let's say he did something in good faith, but because of the other directors, some liability arised due to the third party. This person, the additional director, will not be held liable. And they are also not required to hold any qualification shares. And a very important point, these are additional directors. So when we are talking about the total number of directors, these additional directors will not be taken into account. So the correct answer will be 1, 2, and 3. They are not counted for reckoning the proportion of the total number of directors. Okay, so the fourth statement is incorrect. 1, 2, and 3. 1, 2, and 3 statements are correct. Okay. When RBI removes a chairperson, a director, CEO, or officer under the section 36AA, he may leave the post vacant until the shareholders elect a replacement, appoint a suitable person in their place for up to 3 years, refer appointment to SEBI, require the bank to appoint replacement within 30 days. So when RBI removes a chairperson, a key person from the board, what can the RBI do? Will RBI leave it to the shareholders to elect a person on this vacant post? Or RBI can appoint a suitable person on their own? Can they refer it to SEBI? Or the bank is required to appoint a replacement within 30 days? So usually RBI will give opportunity to the bank. But if the bank is not able to appoint anyone, then RBI will appoint a suitable person in their place for a period up to 3 years. Right? So such person will hold office at the pleasure of RBI. Appointment will not be for a period exceeding 3 years. It is extendable, not exceeding 3 years at a time. Again, they will also not incur any obligation or liability for any action taken in good faith. All right. So the correct answer will be B. When RBI removes a chairperson, they can appoint another person in their place. Which of the following are the components of MCLR, the marginal cost of lending rate? When we are talking about the regulation of banking business, RBI from time to time has determined what will be the basis for the interest rate on loans, right? Starting from the BPLR, the base rate system, the marginal cost of fund based lending rate. So, what are the components? The marginal cost of funds, borrowings plus return on net worth, negative carry on account of CRR, operating costs, or tenor premium. So, which of the following are the components? The MCLR. What is the meaning of marginal cost of fund? Marginal cost of fund, the marginal cost on borrowing and return on the net worth. What is negative carry on account of CRR? Because the returns on the CRR balances are zero. That is why the negative carry is to be included. Operating costs, providing the loan product, cost of raising the funds, all of these are included. Tenor premium, the costs they arise from the loan commitments with longer tenor, right? Longer tenor, higher cost. So all of these are the components of MCLR. All of these are the components of MCLR. So it is a tenor linked benchmark. So various maturities are incorporated. Overnight MCLR, 1 month, 3 months, 6 month, 1 year. For any longer maturity, also the banks are permitted to publish the MCLR for different maturities every month also. All right. So all of these four are the components of MCLR. A bank sanctions a floating rate rupee loan in February 2015. Which benchmark applies? So, a floating rate rupee loan is sanctioned by a bank in February 2015. Will the benchmark be BPLR, base rate, MCLR, or the repo linked lending rate? So, the base rate was introduced when July 1st, 2010, it replaced the BPLR system. BPLR was introduced in 2003 to bring the transparency, but it failed. Why? Because the banks could lend below the BPLR. Then the base rate came in 2010. All the lending rates common all across all the categories of borrowers, and the rate of interest, it was the base rate was then replaced by the MCLR. It was replaced in 2016. Okay. So all the floating rate rupee loans sanctioned between 1st July 2010 and 31st March 2016 were priced with reference to the base rate. Right, beyond 2016, now the MCLR was used. So here, February 2015 is there. That is why the correct answer will be base rate. Okay, then the MCLR came on 1st April 2016. So all the loans before 31st of March 2016 are as per the base rate. All right. A bank issues a certificate of deposit on 1st of December. When can it buy back? When can the bank buy back the certificate of deposit at the prevailing market rates? Immediately after issue, after 30 days from the issue date, only at maturity, after 7 days from the issue date. What is certificate of deposit? Are the banks allowed to issue certificate of deposit? Yes. It is as per the money market reforms. Okay. And other than banks, other institutions are also allowed to issue the certificates of deposits. So, what is the buyback requirement? Who all are allowed? Scheduled commercial banks, RRBs, SFBs. In the primary market, they are issued in the dematerialized form, held with a depository, registered with the SEBI. They are discounted instruments issued to all persons resident in India. The minimum denomination is 5 lakh. The minimum tenure is 7 days, right? So thus the banks, they can buy back the CDs at the prevailing market rate not before 7 days from the issue date. All right, so they can buy back at the market rate after 7 days of the issue date. All right, after 7 days. Okay, the minimum amount out of the net profit which is transferable to the reserve fund each year after adjustment or provision towards bonus to the staff by the banks incorporated in India is 25%, 20%, 10%, or there are no specifications. Banks, they are required to maintain the reserves, right? There's a creation of reserve fund. Every banking company incorporated in India has to create a reserve fund out of the profits as shown in the profit and loss account every year. An amount equivalent to not less than 20% of such profit has to be transferred. Now, this amount has been increased. It has been increased to 25%. Earlier it was 20%, now it has been increased to 25%. Okay. Now, the method of calculation has also been changed. Earlier, the transfer of profit was required to be made before making adjustments towards the bonus to staff. Now it has been decided that the transfer to the reserves may be made after the adjustment or the provision towards the bonus to staff. And if the banks, they want to make any appropriation from the reserve fund, they need to report it to RBI within 21 days of the appropriation. They need to explain the circumstances in which the appropriation was made. All right. So the correct answer is A. Which of the following statements are false? You need to mark the false statement. Only the scheduled banks have a duty to maintain cash reserve under the section 42 of the RBI Act. Every banking company has to maintain liquid assets as required under the section 24 of the Banking Regulation Act. The share capital and reserves of the banking company form part of its demand and time liabilities. The cash reserve required under the section 42 of the RBI Act will be a minimum of 3% of the demand and time liabilities. You need to mark the incorrect statements. You need to select the false statements. Which statements are false? As per the section 42, only scheduled banks are required. Yes. For the non-scheduled banks, section 18 works. So this is correct. Section 24 requires liquid assets to be maintained. SLR true, right? Section 42, however, talks about the cash reserve requirement, the CRR. So not correct. And the cash required will be a minimum of 3%, again not correct. Okay. Yes. So the false statement should be C and D. The false statements are C and D. When we talk about the quantum of reserve to be maintained, it is stipulated by RBI from time to time. Okay. Average daily balance is to be maintained. Then, which conditions apply to the publication of accounts and balance sheet under the section 31? In the newspaper must be published at least once a week. Journal other than banking, commercial, financial, or economic journal is excluded. Listed banks must publish the unaudited quarterly results as per the SEBI format. Publication must be completed within 3 months of the period end. So now we are talking about the audits, returns requirement. Furnishing of accounts and balance sheet to the registrar, to the RBI, to the SEBI. So what should be the correct answer? What will be the correct answer? About the quarterly returns to SEBI, all the banks who have listed with stock exchanges, they're required to publish their unaudited quarterly results as per the format prescribed by SEBI, right? The banking company's profit and loss account, when they prepare it, they also need to place it before the annual general meeting in the AGM, right? And what else the provisions require? So what should be the correct answer regarding the publishing? When we talk about the balance sheet prepared under the Banking Regulation Act, the publication has to be made in a newspaper which is in circulation within the banking company where it has the principal place of business within a period of 6 months from the end of the period to which the account, the balance sheet, they are prepared. Okay. So statement 1 should be incorrect. At least once a week. No, it has to be published. It has to be published for the period within a period of 6 months, right? Newspaper means any newspaper, general, published, which is published at least once a week. Okay, we are talking about the eligibility of the newspaper. So this should be correct, right? Publishing should be done within 6 months, not 3 month period, but 6 month period. Which newspaper? Newspaper which is widely in circulation where the banking company has its principal office. Meaning of widely circulation means at least once a week it is published, right? But it does not include a journal other than a banking, commercial, financial, or economic journal, right? So journal other than banking, commercial, financial is excluded. And the unaudited quarterly results to the SEBI. Okay, so the correct answer will be A, 1, 2, and 3. This publishing should be completed within 6 months from the end of the period to which the account and balance sheet relate. Submission to the RBI, 3 copies of the balance sheet, profit and loss account within 3 months from the end of the period should be made to the Reserve Bank. To the registrar as well, 3 copies will be submitted. And at a conspicuous place, they also need to display the balance sheet, particularly the foreign banks. Okay. Under the Section 24 of the Banking Regulation Act, the return on liquid assets must be submitted. What is the requirement for the returns on liquid asset? Returns on liquid asset. Within 10 days from the end of the month, within 20 days from the end of the month, within 30 days from the end of the month, or within 45 days from the end of the month. So every banking company has to submit several returns to RBI. When we are talking about a return of its liquid asset, it has to be submitted within 20 days from the end of the month to which it relates. So option B is correct. The rule, the format is given in the banking regulation companies rule. Okay, and it will include the particulars of the asset and demand and time liabilities as at the close of business on each alternate Friday. All right, other information can also be seeked by RBI. Monthly returns are also to be filed. Okay, monthly return under the section 27 on the asset and liability before the close of the month succeeding to which it relates, right? Under the 2013 amendment to section 18, penalties for the CRR default. If the bank fails to maintain the CRR, the stipulated minimum CRR, Then what is the penalty? 3% above the bank rate for the first day of shortfall, 5% above the bank rate for each subsequent day if the default continues. Penalty applies only if the default exceeds 7 days. RBI is empowered to demand the penalty for any daily default. Let us once again talk about the different returns. Returns on the accounts and balance sheet have to be submitted within 3 months from the end of the period to which they relate. Returns on asset in India within 1 month from the end of the quarter, and return on the unclaimed deposit within 30 days of the close of each calendar year. Right? So remember the monthly returns, quarterly returns, and the calendar year, yearly returns. For the CRR, RBI uses CRR to as a tool to increase or decrease the money flow. As we have already discussed, increasing the CRR will decrease the money flow. Decreasing the CRR will increase the money flow in the economy to control the inflation or deflation, right? Whatever CRR is stipulated, the banks they have to maintain on a daily basis. And if it fails to maintain the CRR on any day of the year, the defaulting bank will be liable to pay a penalty at the rate of 3% above the bank rate for the first day. And if it continues, then 5% above the bank rate for all the days it continues. And then the officers responsible will also be held liable if it continues more than the stipulated time, the shortfall. Okay, so the correct answer will be D, 1, 2, and 4. Which of the following applied to a special audit under the section 30? So when RBI conducts the special audit, what provisions are followed? It may cover the specific transactions or classes of transactions for specified periods. It is conducted by a qualified auditor or a statutory auditor as directed by RBI. It is binding on both the bank and the auditor. Audit charges are borne by the RBI. So what is the special audit? Special audit of the accounts of the banking company. This order is given when only where the RBI is of the opinion that the audit is necessary, either in the interest of the banking company or the depositor or in public interest. It can be for a transaction or a class of transaction of such periods specified by RBI, right? The same auditor of the bank can be ordered to conduct it, or another person can be appointed by RBI. After the audit, the auditor will be required to submit a report to RBI, and a copy will also be given to the bank. In case of the special audit, a copy is sent to RBI as well as the bank. However, all the charges of the auditor in respect of the special audit is not to be borne by RBI, it will be borne by the banking company. So the correct answer should be A. 1, 2, and 3. All the charges of the special audit are borne by the banking company. All right? Okay. An inspection is carried out at the behest of the government of India. Which obligations arise? So if the government has given direction to the RBI. Now, RBI conducts the annual financial inspection of the banking companies under the section 35 of the Banking Regulation Act every year. It covers all the types of risks under the risk-based supervision through the SPARK, right? The supervisory program on assessment of risk and capital, and RBI issues the risk assessment report. Other than that, also RBI can conduct inspection, right? RBI will also conduct the inspection if directed by government. It becomes mandatory. When an inspection is carried out at the behest of the government, a copy of the report must be sent to the government mandatorily. And in other inspections, it is at the opinion of RBI whether they want to send the copy to the government or not. Then, on the basis of the report, The government can take further action. They can prohibit the bank from accepting deposits depending upon the findings in the inspection in the report. Obviously, government will give an opportunity to the banking company to make a representation. All right. So, copy of inspection must be sent to the government. Government may prohibit the bank from accepting further deposits. They will give an opportunity to be heard to the banking company, and the government can also publish the inspection report. Yes. So, the correct answer will be 1, 2, 3, and 4. All the statements are correct. All right. All the statements are correct. Publish mean in the public notice. In the public notice. So now every person in the country will have the information about this inspection that was conducted, all the findings that were there in the report. So the correct answer will be D. Shareholders of an acquired bank are dissatisfied with the compensation offered under the section 36 AG. What recourse is available for them? They can apply directly to the RBI. They can request the central government to refer the matter to the tribunal. They can file a writ petition in the High Court without the tribunal reference. They can seek arbitration under the Companies Act. So, what is acquisition? Acquisition of undertakings. The central government can acquire the undertakings of the banking company. Undertaking means the entire organization where the banking company has failed on one or more occasion to comply with the directions given by the government. It has conducted anything in detrimental to the interest of the depositors, right? Before, however, acquiring the assets of the company, a reasonable opportunity to be heard will be given to the banking company. Now, when the acquisition is done, all the assets and liabilities of the acquired bank shall stand transferred to the central government, or the central government can transfer it to another bank, any company or corporation. And the shareholders of the acquired bank, they have the right to get compensation. Every person who immediately before the appointed day means when it is acquired, they have the right, who were registered as a holder of shares, they have the right to get the compensation. And if they're not satisfied by the compensation offered by the government, they can refer an appeal to the tribunal. Reference will be made to the tribunal, subject to the satisfaction of certain conditions. And if the acquisition of undertakings of a foreign bank is done in India, then also a reference has to be made to the tribunal if requested by the foreign bank, right? So the reference will be made to a tribunal that is set up by the central government, not to the High Court, not to RBI, or not under the Companies Act. All right. So the government has the power to make scheme. The government will set up tribunal if required. Okay. Under the section 44A of the Banking Regulation Act, voluntary amalgamation of two banking company requires approval by. So two companies, they want to amalgamate. They want to join. So they need approval by a simple majority of the shareholders present. RBI directly without the shareholder approval, two-thirds in the value of shareholders present in person, central government without consultation. So, what is the meaning of amalgamation? A banking company may be amalgamated with another banking company. For that, the banking companies will prepare the scheme, right? They will place it before the shareholders of the two companies separately. So, there are two banking companies A and banking company B. They prepared a scheme for amalgamation. The shareholders of Bank A and the shareholders of Bank B. Separately, this scheme will be kept in front of them. And two-thirds of the shareholders of Bank A and two-thirds of the shareholders of Bank B, they need to give their approval. Only then the scheme will be passed. And those shareholders that do not agree, they do not want to be a part of this amalgamated institution, who votes against the scheme, they have the right to claim the value of their shares and they can leave the amalgamated company. All right. So once this scheme is approved by the shareholders, then it will be submitted to RBI. Then RBI will sanction the scheme. And then when this scheme is applied, the banks are amalgamated. The RBI can also direct that the amalgamated company, let's say A is amalgamated into B. So now A will stand dissolved from the specified date. All right. So the correct answer will be two-thirds in value of the shareholders present in person. Okay. So the two-thirds of the value of the shareholders should give their assent, their consent. Only then the scheme will be passed on to RBI for their sanction. Okay. Even the government can order the amalgamation of the companies. During a moratorium, a banking company attempts to repay the depositors without the central government direction. What is the consequence? Now, RBI is authorized to apply to the central government for an order of moratorium wherever there's a good reason to do so. After considering the application, the central government may pass an order of moratorium. Moratorium means staying the commencement or continuation of any action, any proceeding against the banking company. This can be extendable from time to time, but the total period of the moratorium will not be more than 6 months. Right. During the period of moratorium, the banking company shall not make any payment to the depositors or discharge any liability or obligation unless otherwise directed. If this is done by them, it will violate the moratorium order and now the moratorium will be discontinued. The proceedings for the let's say acquisition, amalgamation, winding up, whatever. It will continue from that point onwards. Okay, so the repayment violates the moratorium order if without the government permission. All right, so the correct answer is B. Under the Section 38 of the Banking Regulation Act, High Court shall order the winding up of the banking company if. What are the reasons for which the High Court can order the winding up of the banking company? When the bank is unable to pay the debts, RBI applies for winding up under the Section 37 or 38. The shareholders pass a resolution for the winding up. SEBI directs the winding up. So when we are talking about the winding up of the bank, winding up means what? Dissolution, liquidation, shutting down the business as usual. Okay. So the High Court can order the winding up of the banking company if the banking company is unable to pay its debts or an application for the winding up has been made by the Reserve Bank, right? However, shareholders cannot pass a resolution for winding up, or SEBI also has no right here. So the correct answer will be A, 1 and 2 only. 1 and 2 only. RBI also has the right to order a winding up. Government can also have a right to order a winding up, right? High Court can also order. RBI is now, however, bound. If the central government directs the RBI for the winding up, the RBI is bound to make an application under the Section 38 to the High Court, right? If they conducted an inspection on the scrutiny made, they found that the banks are conducting anything which is detrimental to the interest of the depositors, after giving chance to be heard, they will apply for the winding up, right? When can RBI apply for winding up? When the banks fail to comply with the requirement of the minimum paid up capital, they are not entitled to carry on the banking business. They do not have the license under Section 22, or the license have been cancelled. They fail to comply with the requirements of the Banking Regulation Act. A compromise arrangement cannot be made. Then RBI can also order. Okay. A depositor has rupees 400 in their savings account. during the winding up process, how much they get, how much gets the preferential priority under the section 43A. Entire 400 rupees, 100 rupees only, 250 rupees only, none if they are covered under the DICGC. So when the winding up process starts, there's an official liquidator attached to every high court. They can conduct the proceedings of winding up, or any other person can be appointed as the official liquidator. The liquidator will make a preliminary report to the High Court within 2 months of the winding up order. The assets for making the preferential payment. Within 15 days of the winding up order, they will give notice calling for claims for the preferential payment. 15 days, right? Claims from every secured, unsecured creditor as well. The claim of every depositor of a banking company will be already deemed to have filed. Preferential payment is given to the depositors. All right. First, preferential payment is given to those who have made a claim within 1 month of the notice given by the liquidator. After that, depositors in savings bank up to 250 rupees are given the preferential payment, and they will get rupees 250. So here the depositor had 400 rupees in savings account. They will get rupees 250 under the preferential priority. All right. The central government directs RBI under the section 35 to apply for winding up. When can such direction be issued? When can the central government issue a direction to the RBI for winding up? When RBI inspection or scrutiny report shows affairs detrimental to the depositors without giving opportunity to the bank to represent themselves, only after SEBI approval, only if the shareholders they demand the winding up. So the correct answer we have already discussed. When an inspection was carried out, in the scrutiny report it is found that the bank is involved in any detrimental act, then the government will give order of winding up, and it is mandatory, it is binding. Failure to produce books, accounts, or information under the RBI Act. There are certain penalties for contravention under the RBI Act and under the Banking Regulation Act. So, under the RBI Act, the Chapter 5 deals with the violation. The banking companies are required to make applications, furnish returns, statement. If any statement is false, knowingly it is false, or willfully they're trying to omit any material statement, then the responsible persons they are punishable with imprisonment up to a period of 3 years and a fine, right? The person is duty bound to make, they are punishable of a fine up to 1 lakh rupees for each offense, and a continuing offense 5,000 rupees for each day. Okay, so the correct answer will be C, 1, 2 and 4. 1, 2 and 4. All right, 1, 2 and 4. So the failure to produce any books. The question is asking about failure to produce any books. Here the imprisonment will not be there. All right. If they willfully make a wrong statement, they try to hide a material information, then imprisonment up to a period of 3 years and a fine will be there. Failure to produce the books, fines are there. Contravention of other provisions of the Banking Regulation Act or default in complying with the obligations under the scheme attracts fine up to 20 lakh rupees, fine up to 1 crore or twice the amount involved, whichever is higher, fine up to 50,000 rupees per day, imprisonment up to 5 years. So when we are talking about the Banking Regulation Act, if a false statement is willfully made, willful omission to make any material statement, punishment is 3 years imprisonment and fine that can be extended to 1 crore. If the person fails to produce any book, any document, any statement, they fail to answer any question which is asked by RBI during the scrutiny, then they will be punishable with a fine that can be extended to 20 lakh rupees, and continuing offense 50,000 rupees. All right. So what should be the correct answer? Here they are talking about the contravention of other provisions. So the correct answer will be D. 1 crore rupees or twice the amount involved, whichever is higher. All right. Yes, this is the correct answer. Okay. Which of the following statements regarding audit of the state bank are correct? Audit may be conducted by a person qualified under the section 226 of the Companies Act 1956. Directors, members of the local board, local committees, officers of the state bank are eligible to be the auditors. Appointment of the auditors requires previous approval of the RBI. Auditor's report and central board's report must be placed before the parliament. So when we are talking about SBI, the accounts and audit, SBI has to close its books and balance account each year on 31st March, and within 3 months of the closing date, they need to furnish it to the government and RBI, their balance sheet, profit and loss account, along with the auditor's report, right? By which is a report by the central board. This audit can be conducted by any duly qualified person as per the Companies Act. However, no director, member of the local board, local committee, or an officer of the state bank will be eligible. All right. The directors, member of the local board, they are not eligible to be the auditors. All right. They are not eligible. Then whoever is appointed as the auditor, it will be done by the state bank with the previous approval of the reserve bank. Auditor's report to the central board will be placed before the parliament. Okay, so the correct answer should be 1, 3 and 4. 1, 3 and 4 option is not given. Let us say C. Okay, second statement is incorrect. These auditors should be independent. No director, member of the local board, local committee, or an officer of the state bank, they're not eligible to be the auditor. Okay, so the second statement will be incorrect. Which of the following is not correct about the capital structure of an RRB? Central government 50%, sponsor bank 35%, state government 15%, NABARD 10%. Very easy question, and it is one of the most repeated questions in every exam. So, RRBs are established as per the RRB Act of 1976 by the government on request of a sponsor. Okay, the sponsor bank is a bank by which the RRB is sponsored, and the sponsor bank will hold 35% of the issued capital. Central government will hold 50% and the state government will hold 15%. NABARD is not required to hold anything. Okay, 50%, 35% and 15% is the requirement for the central government, sponsor bank and the state government. Then every RRB is a body corporate. It has perpetual succession. It has a common seal. They can hold and dispose property. They can sue and they are eligible to be sued in their own name. RRB will work in a compact area of operation, a few districts, homogeneous agro-climatic condition, right? Management of the affairs is given to the board of directors. NABARD, the board of the directors consists of a chairperson appointed by the sponsor bank in consultation with NABARD. A sponsor bank appoints one of its own officers as the chairperson in consultation with NABARD. All right. Who monitors the progress of RRBs through inspection, internal audit, and scrutiny? RBI, sponsor bank, NABARD, or the central government? The accounts and audit. Every RRB has to close their balance account on 31st March, and the auditors will be appointed with the approval of the central government. Any person as per the Companies Act is eligible to be the auditor of the RRB. The auditor's report on the working of the bank will be laid before the parliament. However, in respect of the inspection, internal audit, scrutiny, suggesting the corrective measures, it is the responsibility of the sponsor bank. So the sponsor bank is responsible. The sponsor bank is empowered to monitor the progress of the RRBs. As per the Government of India's August 2019 amendment, what is the maximum number of whole time directors that can be appointed in the nationalized banks? So, the other public sector banks. An amendment was made in 2019. As per the amendment, the maximum number of whole time directors that can be appointed, two, three, four, or five. The correct answer is C, four directors. All right, four directors. So when we talk about the board in a nationalized bank, it will consist of the directors who can be nominated or appointed by the government or elected from among the shareholders. Chairperson, managing director, the not more than four other whole-time directors. Earlier it was three, now it has been increased to four. One director who will be an official of the central government, one director who has necessary expertise in relation to the supervision of the commercial bank, one director representing the officers, another workman employees, one chartered accountant that should have not less than 15 years experience, and six other directors nominated by the central government. Whole time directors, executive directors will be maximum four. Shareholders may also elect up to a maximum of three directors. Okay, and they will have to fulfill the fit and proper criteria. According to RBI's Master Direction 2019, which of the following are the disqualifications for directors on the public sector banks board? Members of parliament, state legislature, local government, candidates with connections to defaulting firms, board members in the rival banks, links with the chartered accountancy firms, links with financial institutions, insurance firms, or non operative financial holding companies. So, when we talk about the fit and proper criteria, members of the parliament, state legislature, local government not eligible. Then the candidates, they cannot be board members of rival banks, directors that have connection with defaulting firms or chartered accountancy firms, again not eligible. They should have no links with financial institutions, insurance firms, and the non-operative financial holding companies. So all of the above. All of these are ineligible to be appointed as directors in the board. All right, these are the updated norms. A primary credit society becomes a primary cooperative bank after commencement of the act. Within what period must it comply with the minimum capital requirement? So, when we are talking about the cooperative banks, a cooperative society registered under the State Act or the Central Act, when gets licensed from RBI, they become a cooperative bank. Okay, there's the paid up capital reserve requirement, uh, not less than 1 lakh rupees, which is required. The banker banking, bank in the name should be there, paid up capital and reserves. Okay, however, here they are given certain time to comply with the minimum capital requirement. A primary credit society that becomes a primary cooperative bank after the commencement of the act for a period of 2 years from the date it becomes a primary cooperative bank. This 2 years grace period is given to them. Within 2 years, they will have to comply with the minimum capital requirement. All right, so the correct answer is C. Cooperative banks must also maintain a cash reserve equivalent to at least 2% of the demand and time liabilities, 3% of the demand and time liabilities, 4% or 5%. Cooperative banks, other than the scheduled cooperative and the scheduled state cooperative, they need to maintain in India a net balance in current account, sum equivalent to at least 3% of its total demand and time liabilities in India. If we are talking about the primary cooperative bank, then the balance in current account with the central cooperative will also be taken into account. Right? That's the whole procedure. Which of the following entities are eligible promoters for setting up of a payment bank? Who all can set up a payment bank as per the differentiated bank regulation? Existing non-bank PPI issuers, NBFCs and cooperative business correspondents, mobile telephone companies and supermarket chains, foreign owned companies incorporated outside India. Who all can be the promoters, who all can set up a payment bank in India, a payment bank. Eligible promoters include existing non-bank prepaid instrument, NBFCs, corporate business correspondent, mobile telephone company, supermarket chains. Yes, a promoter group can also have a joint venture with an existing scheduled commercial bank. Correct. However, foreign owned companies incorporated outside India cannot be the promoters. They cannot set up a payment bank in India. Okay. So foreign owned companies incorporated outside India will not be allowed. These promoters also, they have to fulfill the fit and proper criteria. Okay, the capital requirement will be 100 crore. Promoters' contribution will be at least 40% for the first 5 years. All of these things will be maintained. A promoter group has only 3 years of track record in running its business. Can it be eligible to promote a small finance bank? Yes, if it is resident owned. Yes, if RBI grants exemption. No minimum 5 years track record is required. Or yes, if it is an NBFC. So when we are talking about the eligible promoters of the small finance bank, resident individuals or professionals that have 10 years of experience in banking and finance will be eligible. Companies and societies owned and controlled by residents will also be eligible. Existing NBFCs, MFIs, LABs, they can convert into SFB. However, there's the fit and proper criteria, right? The promoter or the promoter groups should have a sound track record of professional experience or running their business for at least 5 years to be eligible as a promoter of the SFB. So here they will not be eligible. They are not eligible to set up the SFB. Okay. Which of the following restrictions were imposed on the equity contributions in local area banks? NRI contribution to the equity not exceeding 40% of capital. Family holdings among the promoter group not exceeding 40% of the capital. Lock-in period of 3 years from the date of licensing. Voting rights of the individual shareholders capped at 10%. So for the local area banks, it was decided in 1996 to establish the local area banks. They are established in the private sector. Minimum startup capital will be 5 crores. Promoters will bring the entire minimum share capital upfront. NRI contribution to the equity and that held by a family among the promoter group, however, should not be more than 40%, right? And a lock-in period of 3 years from the date of licensing. They cannot take back their contribution before 3%, right? And the voting rights were restricted at 10%. So the correct answer will be D. All of these statements about the LAB are correct. right? Licensing requirement, they are registered as a public limited company under the Companies Act, the Partnership Act, the LLP Act, and they are given license under the Banking Regulation Act, right? And included in the second schedule of RBI. Okay. Which NBFCs do not fall under the base layer of RBI's scale-based regulatory framework? Again, a very important question. You need to remember the different NBFCs that fall in the four layers: base layer, middle layer, upper layer, and top layer. So, which of these do not fall in the base layer? Non deposit taking NBFCs below 1000 crore asset size? Yes. NBFC peer to peer lending platform, account aggregators, NBFCs not availing public fund. However, CICs and IFCs, both of them, they come under the middle layer category, not in the base layer. They fall in the middle layer category. So the correct answer should be C, 4 and 6. Okay. Which NBFCs they come in the base layer? First, those NBFCs that do not have any public interface, they do not have any public contribution. Non-deposit taking NBFCs below the asset size of 1000 crore, peer-to-peer lending platform, account aggregator, non-operative financial holding companies. They are in the base layer. Okay. CICs and IFCs, they come under the middle layer. Non-deposit taking NBFCs with asset size of 1000 crore and above come under which layer? Below 1000 crore asset size, they come in the base layer. Asset size of 1000 crores and more, they come in the middle layer category. What else? All the deposit taking NBFCs. All the deposit taking NBFCs, irrespective of their asset size, will be in the middle layer. Then the non-deposit taking NBFCs with asset size of 1000 crore and above, standalone primary dealers, IFCs, CICs, housing finance companies, and the infrastructure finance companies. What about the upper layer and top layer? Upper layer, those NBFCs that require enhanced regulatory requirement as stipulated by RBI will be there in the upper layer. The top 10 NBFCs in respect of their asset size will always be in the upper layer. Top layer should remain empty. Any NBFC will be transferred from the upper layer to the top layer only if there's a substantial increase in the potential systematic risk. Okay, so the correct answer here is B. Okay, which exposures are reckoned as the sensitive sector exposure for NBFCs? There are certain restrictions. There are certain prudential norms that the NBFCs they need to follow, like the concentration of credit investment for a single borrower or party 25%, single group of borrowers or parties 40%. There's also the exposure to the sensitive sector, which is capital market and the commercial real estate. For this, the NBFC should fix a board approved internal limit. All right. So the correct answer will be A, 1 and 2. Agriculture lending and MSME financing, these are not sensitive sectors. All right. The sensitive sectors are capital market and commercial real estate. At the time of the Narasimham Committee's review, the combined CRR and SLR requirement was. So, two committees were set up under Narasimham Rao. The first committee was the Committee on Financial Systems 1991, right? Second committee was the Committee on Banking Sector Reforms, right? Or the Committee for the Review of the Financial System. In 1998, it was set up. Okay, so the Narasimham Committee one, they observed certain things like there was a high CRR SLR requirement, which was a tax on the banking system. What was together the CRR and SLR requirement aggregating to 53.5%. Other than this, they also recommended lowering of the CRR SLR. CRR has been brought down to single digit, SLR to double digit, around 18%. They also said that the directed credit program was deteriorating the quality of loan portfolio. Interest subsidy again was a loss of precious profit for the banks. Rising NPA was another cause. The Narasimham Committee too recommended various banking sector reforms to enhance the competition, the market forces, prudential measures, institutional and legal measures, supervisory and technology related measures. Competition enhancing means allowing the private sector and foreign banks to enter the voluntary retirement schemes, CBS. Then market forces, repo rate, targeted long-term repo rate were allowed. Prudential measures, the CRR, SLR was brought down, right? CRAR was introduced. The capital buffer was introduced. Know your customer, anti-money laundering. Institutional and legal measures were Lok Adalat, Surfaci Act, CIBIL, CCIL, IBC. Supervisory measures were the Board for Financial Supervision that was set up, the CAMEL's supervisory rating system, and technology related, we already know, Infinet, RTGS, NEFT, NACH, ATMs. All of these were the technology measures. All right? Okay. Which statement correctly describes the statutory status of the FSDC, the Financial Sector Development Council? It is a statutory body under the RBI Act of 1934. It is a statutory body under the Companies Act of 2013. It is a constitutional body or it is not a statutory body. So, what is the FSDC? It was constituted in 2010. Different regulators are there. RBI is there for commercial banks, NBFCs, SEBI is for the capital market, IRDAI is for the insurance, PEFALDA for the pension fund. So the heads of all of these financial regulators, they have come together to promote financial sector regulation, development, enhancing the inter-regulatory coordination for better efficiency, right? So the FSDC is a is it a statutory body? No, it is not a statutory body. It is not established under any act. It is a council where all of these regulators they come together to improve the financial sector stability, right? Who is the chairperson of the FSDC? Chairperson of the FSDC is the finance minister. Other than that, the finance secretary will also be a member. Secretaries from the Department of Economic Affairs, chairperson of the IBBI, the chief economic advisor, all of these will meet for the development of financial sector. Now, let us solve some case study based questions as well. A Canadian bank incorporated outside India has branches in Delhi, Mumbai, and Chennai. Its annual profit from Indian operations is rupees 50 crore. The bank seeks exemption from deposit requirements during citing the adequacy of deposits already made. Which of the following statements are correct? It must deposit 15 lakh with RBI since it has branches in India. It must deposit 20 lakh because it has a branch in Mumbai. It must deposit 10 crore annually, 20% of the Indian profit. Exemption can only be granted by the central government on RBI's recommendation. So, what is the requirement for the foreign banks? If they have places in India, not in Bombay or Calcutta, then 15 lakh deposit they need to keep with RBI at all times plus 20% of the profit that they generate in India from their Indian operation. However, here it clearly says that it also has a place of business in Mumbai. So it will have to deposit 20 lakh rupees with RBI and 20% of the Indian profits. The profit from Indian operations is what? 50 crore rupees. So 20% will be 10 crores annually. And if they want exemption, They cannot seek it from RBI. They have to get the exemption from central government on RBI's recommendation. So the correct answer will be C, 2, 3, and 4. First statement is incorrect. An Indian banking company has branches in Gujarat, Maharashtra, and Kolkata. Its paid up capital and reserves total rupees 8 lakh. Which of the following apply? Minimum requirement is 5 lakhs since it has branches in more than one state. Minimum requirement rises to 10 lakh because one branch is in Kolkata. The bank is compliant since it has 8 lakh rupees capital or reserves. The statutory ceiling for such banks is 10 lakh rupees. So what is the requirement for the Indian banks? We have already covered questions on this topic, so you can answer it. So if you remember when we were talking about the paid up capital and reserve requirement for the Indian banks, if it has a place of business in more than one state, 5 lakh rupees. And if any of such place of business is in Bombay or Calcutta, then 10 lakh rupees. So it has place of business in more than one state. Gujarat, Maharashtra, and Kolkata. And Kolkata, this means 10 lakh rupees will be required to be maintained, not 5 lakh rupees, right? 10 lakh. Then the bank is not compliant because it has 8 lakh rupees. So you will be able to answer such questions only if you understand the concept, if you remember the concept in your exam. And these questions, they are asked. They will give you a scenario and you will have to make a judgment on it. Okay? So the correct answer should be 2 and 4. D should be the correct answer. All right, D will be the correct answer. Mr. A, who is previously adjudicated insolvent but later discharged, applies for a senior management role in a banking company. Mr. B, who is convicted of an offense involving moral turpitude 12 years ago, also applies. Which of the following statements are correct? Mr. A is prohibited for employment in the bank. Mr. B is prohibited from employment in the bank. Both Mr. A and Mr. B are eligible because their disabilities are time barred. RBI may permit Mr. A, but not Mr. B. So, what should be the correct answer? What should be the correct answer? So, this is from the restrictions on employment. A person who has been adjudicated insolvent or has suspended payment or has compounded with their creditors, not eligible. A person who has been convicted by a criminal court of an offense involving moral turpitude, not eligible. A person who is receiving commission or share in profit which is excessive in the opinion of RBI, not eligible. So time barred situation or exemption is not given. Both of them, they are adjudicated insolvent and the second person has been convicted of a criminal offense. So they won't be allowed. Mr. A is prohibited. Mr. B is also prohibited. RBI will permit only for the remuneration based criteria, not when they are insolvent or they are they have committed any criminal misconduct. All right, so the correct answer will be A. Neither A nor B will be appointed. Mr. B is elected as a director of a public sector bank in 2020. Okay, Miss B is elected as a director of a public sector bank in 2020. She has already served 6 years continuously and has proposed for re-election in 2006. Which of the following will be correct? Maximum tenure on board is capped at 6 years. She can be re-elected for another 6 years if RBI approves. RBI directions prohibit tenure beyond 6 years. Renewal is possible only if the tenure blocks do not exceed 5 years. So we are talking about a director. We are talking about a director. What is the time period for appointment of a director? Maximum tenure on the board is capped at 6 years, and RBI prohibits tenure beyond 6 years. All right, continuously. Continuously. So the correct answer should be D, 1 and 3. All right, 1 and 3. The bank considers granting an unsecured advance to XYZ Private Limited, where one of its directors is a partner. So in XYZ Private Limited, one of the directors of the bank is a partner. Can the bank grant an unsecured loan or not? Such an unsecured advance is prohibited under the Section 20. RBI may allow if within approved limit. Exemption applies if advances against bill for the supplies to the government. Loan is permissible since director is only a partner, not a guarantor. So clearly, if someone is involved in a trading firm, XYZ Private Limited is a trading firm. They're involved as an employee or a director or an agent or a managing agent. It is restricted to give them unsecured loan. Okay? And loan will not be permissible. However, exemption applies if the advance is against bills of supplies to the government. Only this exemption is there, otherwise not. Okay, so the correct answer is B. A cooperative bank is approached by an insurance company registered under the Section 3 of an Insurance Act seeking a term loan for infrastructure expansion. The bank cannot lend since insurance companies are NBFCs requiring RBI registration, require the co-lending model between a bank and NBFC. So NBFCs they require registration with RBI. Certain NBFCs are exempt if those entities that already have the registration from a regulator, they are exempt. Insurance companies are also exempt. So the bank can lend since the insurance companies are exempt from the RBI registration. So the co-lending model will work here. Okay, who all are exempt when we are talking about this exemption in the co-lending model? Who all are exempt? Insurance companies registered under the Insurance Act, Nidhi companies under the Companies Act, chit fund company as per the RBI Act, right? Stockbroking companies, merchant banking companies as per the SEBI Act, housing finance company regulated by NHB. Now these housing finance companies have been transferred to RBI. So they do not require registration. So to avoid dual regulation, if they already have a valid certificate of registration from their respective regulator, they need not apply for a registration again with RBI. An NBFC seeks finance from a bank to lend further to individuals for subscribing to an IPO. Lending is permissible since IPO financing is a genuine commercial activity. Lending is prohibited as bank finance to NBFCs for IPO is barred. Lending is permissible only if IPO is of a public sector unit. Lending is permissible only if RBI grants prior approval. So, activities that are not eligible for bank credit also includes finance for NBSCs for further lending to individuals who want to subscribe to the IPO. They want to purchase shares from the secondary market or they want to subscribe to the IPOs. Financing to NBFCs for this is not allowed. So the correct answer will be B. What else? Investment of NBFCs in current and long-term nature in any company by the way of shares or debentures not allowed. Unsecured loans by NBFC to any company not allowed. All the types of loans advanced by the NBFC to its own subsidiaries or group companies not allowed. All right, so the correct answer will be B. And that is all. So we have completed our module A marathon. We have practiced all the important questions. We have revised all the important topics. Like this, we will be covering all the four modules on the YouTube channel. So tomorrow morning, we will complete our module B theory in the capsule lecture. Then in the evening at 8 p.m., we will have the marathon for module B. Right? So if you have yet not joined the capsule batch, make sure that you enroll now. Attend all of the live classes, theory and YouTube both. And before you leave, make sure to like the video, share the video, subscribe to the Oliveboard channel. If you have any doubts, any queries related to any topic, the course, anything, you can let me know in the comment section. Right? I will upload the PDF. You can find the PDF on the Oliveboard website under the courses sections. YouTube PDF is there. Download the PDF, use it for your revision. So thank you so much for attending. I will see you in the morning in the capsule lecture. Thank you. Good night. Take care and all the best.